Hey guys, it's Emily Cressey. So we are going to be talking fast today about something that is sort of a forecast for 2022 and beyond, potentially. I think this is a pretty big issue. It's tangentially related to real estate, and I want to get into it. So again, I'm going to talk fast. The issue is inflation. So we have seen a huge run up in prices in real estate over the past year, 2021, and I think some of that is due to inflation. We have looked at other things going on in other segments. You know, gas prices are up, grocery store prices are up. They say, what do they say? The consumer price index is up 6%, and the producer price index is up 8%, on track to get to 10% by the end of the year. So if the producers are having their costs increase by 10%, there's a gap there between the cost that we are paying. They may not have raised the prices of everything all the way yet because they are hoping this is temporary. But I've been listening to podcasts by economist Peter Schiff. You guys know that I have an economics degree undergrad as well. So it's something I'm very interested in, and I'm concerned about it. A lot of the forecasts are saying we are going into a generationally large period of inflation. A typical inflation rate, maybe 2 to 3%. Right now, we're having 6, forecasting it to go higher. Peter Schiff said it may even go into the 20% range, which would be astronomical. Tyson Chicken has said they are increasing their prices by 19%, and I heard something about the price of pork going up 30%. So you may have noticed this. We've seen in the grocery store there's less meat. It costs more. The ice cream containers are smaller, right? Things are changing in price quite a bit. And the more rapidly this happens, the more of a shakeup it will be for us as consumers. Inflation is essentially the reduction in value of our money. We used to be able to spend $5 and go to the movie theater. Now it costs 10. You know, we used to have that $1 meal at McDonald's, and now it's the value menu. So prices of things keep going up, and we can anticipate the prices going up more significantly and more rapidly over the next year than they have in the past. Who is going to suffer the most from this? I'm afraid it will be workers. Eventually, labor prices will go up. You know, we've talked about labor shortages before. Fewer people are in the workforce. The prices that people have to pay are higher to get labor. Trying to get a handyman for a client right now that's costing pretty much $100 per hour fairly frequently to across the board, you know, to find handyman labor. So yes, so just be aware of that dynamic, and I want to talk a little bit about how to position yourself for it and what I anticipate it meaning for the real estate market. So as these prices go up, if they go up significantly and if wages are the last thing to rise, then working people will be at a disadvantage because we will have less money in our paycheck, or essentially the same amount of money in our paycheck, but costs around us have increased by 20%, right? So the buying power of our money is less. And eventually I do think wages will rise, but it may not be very quickly. So this can create some uh, compression of the standard of living. People might choose to have a roommate longer. They might choose a more modest home. They might choose to move back in with friends, family, or relatives. So in terms of the expansion of the real estate market, the appreciation of the real estate market, which is growth in prices above and beyond that inflation rate, I'm not as sanguine, although I do think prices will continue to go up. If you've been waiting for the market to settle down, cool off, go back to normal, I don't see that happening. Forecasts for housing prices suggest they will continue to rise for the next 5 years. So it may be easier to get a home, but it may not be. And the thing that I don't want my buyers to be in the position of is waiting for the market to get better and then essentially being priced out of homes. Even, you know, last year we were seeing, you know, prices. You could get a single family home for 500,000 in Shoreline, for example, where I was working. Now it's very hard to get one for less than 600,000. So as your approval, or as your, you know, your amount that you're approved for on your loan is locked into your debt and income ratio, your credit, that is not going to change as quickly as the prices, which are bumping up 10-20% per year. So your buying power is going to be decreased. I don't want you to wait and wait only to find yourself buying a lesser and lesser home. The strategy here would be to get into a property sooner rather than later, even if it means you have to go through the hassles, right, of multiple offer situations, making an offer on a couple homes. It's a goal that's worth having because the market is rapidly running away from us at this point. Now, whether or not you're looking at buying a home at this point, what can you do to protect yourself when it comes to your money and your financial position? So the worst place to be right now is owning, we call it holding paper, right? You don't want to be the bank. You don't want to have big loans out, and you don't want to be a retiree. So this is where you are entitled to a fixed stream of income payments. You're going to get $500 a month, for example, because those $500 a month are going to become less and less valuable over time. The next worst place to be is with cash for similar reasons. That cash you have stuffed under your pillow in your savings account set aside for your down payment of your home. The buying power of that is going to be reduced as well. So the place that we always tell people to go in an inflationary economy is into hard assets, durable goods, things that will keep their value. Now, that can of Campbell's soup might have cost $1 at the beginning of the year. It'll cost $1.20 at the end of the year. Who knows? Maybe it'll cost $1.40 by 2024, right? So it may be that holding hard goods is a better store of value than holding cash right now. And so, whether that means you want to stock up at the grocery store, buy lots of toilet paper or cans of soup, I don't know if that's what it means for you. What it means for me is having assets where I store my wealth, and that looks like real estate. And I realize that sounds very self-serving, but even stock market like advisors are telling people to go into real estate. I have seen in some of the markets where I buy rental property outside of the Seattle area, I buy in a couple of other cities where we have a combination of good appreciation rates and cash flow. In those cities, we are seeing corporate buyers from out of state, big companies buying up property there. So they're where they are keeping their wealth, and that's an unusual thing. I've been a real estate investor for 20 years. When the banks all got the properties back in 2008, corporations and institutions did not want to be holding these assets. So now they are going into holding these real estate assets. And so that might be something for you to look at as well. If this is something that you're interested in, I subscribe to a service that kind of gives me updates on some of the things we talked about, appreciation rates, cash flow across the country. I would be happy to share with you on an individual basis which markets are doing well, what the price of entry is. A lot of them are less expensive than Seattle, and you can look at investing there if you like. The third point that I wanted to make as far as where to have your money in an inflationary economy is it's excellent to be leveraged. Leveraged means having a lot of debt. So even if you could put 20% down on a property, if you could go in with 10% down or 5% down, that might be a smarter thing to do. You'd have to run the numbers. Might be a smarter thing to do in principle in an inflationary economy. Imagine how they loan you at the beginning of the 30 years enough money to buy a house, and you pay back at the end of the 30 years essentially enough money to buy a pack of gum or something of the value menu at McDonald's, right? So when that cash that you're paying your mortgage with becomes a wheelbarrow of cash that you're taking to the store to buy a loaf of bread, then your monthly mortgage payment has essentially become a loaf of bread worth of monthly payment instead of something really large and significant. So I'm not predicting that level of runaway inflation, but I do think it'll become a significant factor in our lives and our lifestyles in a way that it has not been for the past 40 plus years that I've been around. So I want to put this on your radar. I think it will be significant. If you're looking to buy, let's go ahead and buy. If you've sold and you're looking to move up, excellent time to do that. Let's do it sooner rather than later so that we don't have the cash sitting in the bank for a long time. If you like the idea of having free and clear property, I hear you, but it might be a good time to leverage, especially if you can refinance, get a home equity line of credit, pull out some of that cash and place it into hard assets, durable goods like real estate with leverage. I think that's going to be a much better position for you. So not trying to be henny penny, say the sky is falling here, but this is something for you to look into. This is something that I am very much looking into and telling my family members about. We are buying more real estate and we are doing it with leverage. So if that's something that you'd like to discuss, I'm happy to help you with it. If you're looking to buy a home, excellent time to do it. Let's get you in there. Prices are not coming back down, in my opinion, with the data we have at this point. Okay, thanks so much for watching, guys. Let me know how I can help. I'll talk to you soon. This is Emily Cressey with HomeSmart Real Estate. My website is homeproassociates.com. We're here to serve